So hello everyone. Apologies for the delay. So my name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So I'm glad to share that we are sort of emerging as one of the largest platform for investing in alternate investments and portfolio management services. So I remember, 3.5 years back when I laid down the foundation of the organization, what was there in my mind is that why don't we create a show in the sense that because we call this show is Ask the Expert Show, why not we create this sort of show or a format wherein we can invite the industry experts and we can read their mind. And if any single client who is sort of able to take the benefit of these shows, I think we are sorted. So keeping that in mind, we've started this, and we're happy to share that we've done more than 100 shows as we speak, and able to read the minds of the experts. So with me, I have Mr. Vikram Kotak, very senior, I would say, fund manager, and he spent about more than 3 decades in the industry. So someone who comes with 3 decades of the industry, I can say that with all I have all my right to say that veteran in the industry who has seen India growing from from not even 1 trillion, I think 0.5 trillion or $0.3 trillion to $3.5 trillion through his eyes. So he's worked with large organization, which is the Deutsche Asset Management, where he managed more than $1.2 billion of assets. More on the equity side. So he brings about very rich experience when it comes to investing in equities. So Vikram, first of all, thank you so much for accepting our request and taking the time out and agreed to speak to all our investors. Thank you.
Thank you, Vikas, and I'm really glad to see that you already crossed 100 mark, and I'm still a little lower than the 3 decades, so I'm a little younger than what you said. So I'm like a 28 year experience, but yeah, it's a long experience, and
Yeah.
yeah. So thank you.
Yeah. So, Vikram, the format of the show is very simple. What we're gonna do is, on behalf of our investor, we'll have series of questions for you. And the idea is first, to make you understand that there are few investors who have joined, and they've joined here for the first time, and they wish to know more about you and your organization, and how are you doing it, and how has been your experience. So, if you allow me, I would like to navigate and go through your life, and in detail, and just understand how was your experience
Sure,
in the past. So,
sure.
Vikram, the first question is, if you can talk to us about your experience of working with large organization when you were talking to some of the FIIs. Your organization is one of the FIIs investing in India, and then plus you're managing some domestic funds. So
Sure.
how has been the experience of last 28 years?
My experience has been very good, and I shifted my field 3 times. I started as a corporate finance and treasury person working for the Garden Vareli Group, then moved to Birla Group. So if you look at my overall experience, I work as employee for the different companies for almost 21 years, and 7 years I'm on my own. So of that, the Aditya Birla Group was the longest, and the Deutsche was second biggest. So of course, I moved from corporate finance treasury to fixed income market, and then finally, I always wanted to come back to equity market. Followed always told me that if you are a great debt fund manager, then you can do very good in equity because you understand balance sheet, management quality, and things in and out. So you can actually do better when you, because equity is all about future, and debt is all about past. So if you have a combination of knowing past well and building that past building blocks into a future, that actually gives you a very good combination. So we normally called ourselves as a conservative investors because, and there are very few who had done debt and equity both in market, very few. You may count on your fingertip, maybe Nilesh Shah is one of that. So very few people who actually did both, and we come in a conservative category because debt market gives you 6, 7, 8% return, and equities are like any number, -100 to +100 or -90 to +100. So we are that bit of concern, but it's a great journey, and learned, as you rightly said, I work for the foreign company Deutsche, where I was managing global money on behalf of the global investors investing to India. And my predominant experience is Indian market. I never tracked a global market except the macro part of it, because macro is very important to track on a global market. If you don't know global macro, then you can't build an India product, right? So because India is part of the global jungle, so we need to know the global macro. But otherwise, I manage mostly India money, and I can say a good size of large cap money and also mid cap money, and not too much into small cap, but yeah, focus more on the large and mid cap. And I was CIO of Birla Insurance for almost 8 years, and there I was managing close to $4 billion at that point of time. Tabhi rupee 55 tha, so I can say $4 billion, but as on today, it's a $3 billion. So I worked there as a CIO almost for 8 years, 7.5 years, and then Deutsche for 2 years. So it's a great experience. You learn all the processes, institutionalization, and a lot of things you improve because you learn over a lot of time. Equity market is such a market which teaches you when you're at 75 or 90. And Buffett says that at 90 I still learn. So I think we are all student in the class. Now someone is a senior, someone is a junior, but market keep on teaching you all the days.
Right. Any memory that you want to share when you were managing fixed income and then moved to equity, and any incidents that you remember where which really give our clients a lot of confidence that how should these two asset class to be looked at differently?
So fixed income is so I always believe in when I pass out my CA, I always followed a very meticulous and disciplined process of asset allocation. And I firmly believe at this stage also that we need to be a very good asset allocator. That's the first. And then what you buy within the asset is very important. So I followed that model from day one. So fixed income is a very essential part of your portfolio. And you have times like COVID when the markets are available at half of the value. If you have a lot of liquid and fixed income money, you can actually use the opportunity. So you need to have that basket of the product. And I follow very simple thumb rule of 100 minus your age as equity, and rest is real estate or gold or equity. Fixed income depend upon what suits you and what's your horizon, what's your risk profile. Uh, Memories, I can say one memory clearly when I was a young boy in 97, Southeast Asian crisis hit the world, the Asia. And I'd seen, 3 months of CP trading at 60%, 6 months of CDs trading at 70%, 60%. So we've seen that period for few weeks. And also we've seen within 5 years, the same CD trading at 5%. So that kind of crazy volatile memory. But I'll tell you, debt market teaches you a lot because you learn a lot fundamental, lot macro, lot global factor, inflation, RBI policy, and these are finally the long-term, stepping stone for the equity market. If you know macro well, equity becomes much easier to play. So that's a big memory on the debt side. On equity side, of course, so many memories. So we've done so many multi-baggers like Bharti. I remember, like I bought in my personal investment. I'm still holding it. So I think there's a great Maruti Suzuki or Abbott or many companies we are like invested very early. So like you rightly said, less than $500 million, $500 billion economy to 3.5 trillion, and still long way to go. I think we have $20 trillion coming in next 15 years. So I think India is in a absolutely a sweet spot.
Right.
And one memory I can share that when Satyam crisis happened, Birla Slim Insurance was the one insurance fund which didn't have any Satyam shares because of the I think proactive approach about the corporate governance and all that helped us. So these are the great memories. Yeah.
Excellent, excellent. So I used to work for Motilal Oswal before starting up this organization, and I remember Ramdev used to tell me that he was like old timer, and he used to say that we Rakesh Jhunjhunwala and I think his name was Chandra Prakash.
Okay.
Yeah, so these were the old investors. They used to mean Nimesh Bhai and all, and it used to be a absolutely fixed income market.
Yes.
So what you're
Yes.
saying is that the average yield used to be in double digit those days, and so is the inflation, of course. But then, having said that, there's a saying that if the foundation is good, building would be much stronger. And the way people used to begin is to understand the fixed income market in
Right.
detail, and that becomes the base, and then you build on
Very,
equity markets.
very true. Very true. Yeah.
So coming back to your organization, so you are the CIO and managing partner at Ace Lansdowne. So can you talk to us about your organization and what is it that what was the reason that you started this A B, and what kind of assets you manage and which are the asset class that you focus on as a
Right, right. So actually, I had a dream always when I was CIO of Birla Insurance that someday, when I used to write for newspapers and TV and all that columns and all that, and always I used to write CIO Birla Salim Insurance. Our view is like that. I wanted to actually dream that someday I should say I'm a owner of the company and I'm writing the views. So I think that was one of the wish and which came true later.
wow.
The idea of building up the company was very clear that to provide a very clearly a ethical ethical and client focused business model where you see the client side also and then build a product around that rather than. So I always believe, that you can either build a marketing company or either build an investment company. Marketing company is more towards, what kind of benefit you are getting completely, and as investment company is more towards the investment goals of the of the client, and looking at his goals and looking at his requirement, we build a business around it. So I always followed the later path. So I'll give one example, like when we were building a business and a lot of deliberation, initial phase, about 2019-20, we started this business. Like we decided that we'll not have exit load in any of our product. So despite SEBI is now telling everyone that there should be no exit load and no close ended and all that, we took a call 3.5 years back, 3 years back. We will not have exit load in any of our product. So I think these are the things, small things, which are very important to really keep in mind when you talk to client, because a client want a money urgently, right? How can he pay 2% exit load on his own money? So we said, no, that's not ethical. So we try to build the ethical and process-driven organization over a period of time. And that's the one reason that Reem was there. It's 3 years now, the journey. Like you said, I'm a managing partner and the co-founder. I own 51%, me and my family. 49 is a Lansdowne partner, which is among the very reputed European hedge fund house, partly owned by Morgan Stanley. And the mindset was same because I also wanted to do a long only product. They also wanted to do long only and very conservative mindset. Europeans, they are more conservative. I'm also very conservative in terms of picking up the stock and quality and all that. So the mindset match, the wavelength match, and that's how we started a JV 3 years back. The day I'm speaking to today, it's a matured organization. We are like now 22-member team. We are adding up 3 or 4 in next 2 weeks. So just slowly kind of building up the business. We spend a lot of time in investing into infrastructure and the licenses. We have today all 4 licenses which are required to operate as a non-mutual fund manager. So we have AIF3 and PMS and advisory, and also we just recently got our offshore license to manage the money. It's a Central Bank of Ireland approved license called a UCIT license, where we can take money from the global clients coming to India. It's a very, very reputed and very stringent structure, and we took the license from that. So we're now duly regulated. You can say that SEBI and Central Ireland regulates us, and building up the long-term journey. And as we all know, Vikas, that is a 20-year opportunity for India. And we believe that 20-year, if we do a good job consistently, I think you'll be able to achieve a good amount of growth.
Right. Can you also throw some more lights on this international license that you talked about? You want to set up your office overseas, or this can be managed based out of your Bombay office?
Yeah, that's a very good question, Vikas, you asked. So we have a London office where our partners are there. So we don't need to set up a separate office. In case I need to shift someone, I can shift to London. But the good part about this license is we got a license to manage money sitting in India. If you remember 10 years back, we are not allowed to do that. And slowly, I think the government has improved the relaxation. And now finally, today, you can sit in anywhere in the world, even in India and Mumbai, or even in Gandhinagar city, and you can manage the global money, which is coming to India. So I think that regulation is quite kind of eased out thanks to the government recently in the last 3-4 years time. And I think we are now had to go, we can sit here and do it. Earlier, I think I remember when I was in Deutsche, I had to shift to Singapore to manage the money.
Right.
So now that structure is over. So now we are regulated. That's why it's a duly regulated structure, and that's a very good.
Things are becoming more flexible. I mean,
exactly.
Intent is looking very clear that even they want more money to come in India. Is that correct?
Absolutely. I think the government's effort, needless to say, in last 10 years has been towards seeing that we are, of course, we are not freed completely, but we have improved over big way in last 10 years in terms of easing out the things. So I think that's a big effort and big opportunity, and everyone realized that in a world which is not looking so equal, India is possibly one of the star where they can deliver over a 7% growth for next many years. So I think a lot of investors are chasing it. You are seeing the recent FII flows in last 2 months. The markets are all driven by FII flows. I think that's the opportunity, and we are going to see this journey going to be continuous. It's not a one time or it's a one-off. It's going to be a regular feature of the Indian market.
So when I speak to some of the veterans like you, I remember there was a time when Indians used to go to abroad and ask for money. बोला यार ये फिर से पैसा मांगने आ गया, तुम्हारा कंट्री कोई रिफॉर्म लेता नहीं है और आप लोग पैसा मांगने आ जाते हो. Now the scenario has changed that these guys are calling, I'm sure you would have experienced that when you would have worked with Deutsche.
Yeah, yeah, absolutely,
You
absolutely.
would say that वो Indian आ गया पैसा मांगने उसको जरा बैठा अभी. You know,
Yeah, yeah.
अभी now the situation has changed to an extent that they are calling themselves and saying that I want to put money in India. So, I mean, nobody could have ever imagined how things have transformed over a period of time. Maybe you can throw more light because you
No,
have seen these times through your eyes.
you're absolutely on spot. I think no question about it. And we've seen this time, struggling time. But wait for 2, 3 years more. Once your rupees start appreciating, they'll come to your office and use a check. So I think that scenario is still yet to come. So
Wow,
I
I'm
think,
waiting for that.
yeah. So I think rupee is structurally going to appreciate from here. And I think the one thing which we're waiting for is the current account deficit to turn into the either a lower number or either surplus number. And I believe that I can't say it will be a surplus all the time unless we improve our export and opportunity globally improves. But I think very shortly we are coming near to the zero.
Yeah,
So that,
almost point two. I think point
yeah, yeah,
zero two. This was never seen before.
yeah, yeah. So I think this will change the whole structure of the Indian currency. Of course, already we are doing very well versus a lot of currencies in the world. I think last year, if you look at the 22 data, I think almost 75% of currencies versus 75% of currency we have appreciated. So that number shows, except US and a couple of more currencies, we had appreciated. But mostly, I think we had seen that we've seen appreciation. So I think that trend has just started. And I think over a period of, with the more economic fundamental improving, I think I'm sure that this number will also, so we'll see a very different times going forward. I think we are fortunate, and I tell young guys that you're more fortunate than me because I've seen the struggle also, and now you guys are on a sweet spot. So actually, it's a great time for the youngsters and the next gen.
Yeah, as you rightly said, I think this is the time our parents would have not seen.
No way.
Perhaps our kids may not be able to see. So
Yeah,
I
I
think we're
remember
living
my
our dream.
I remember my vaguely my Birla Sanam insurance CIO CEO who was actually working for VSNL, Tata Communication earlier, and then Idea Group and all that. He gave me a bonus in a 1 year. I remember post Lehman, and he told me, Vikram, this is my total pension saving. So, so the next generation will tell us like this that what dad you made in a whole life is we made in 2 years. So
True, true. I mean, our new generation would not be even able to digest the fact, the kind of difficulties that all of you have gone through during 90s. And
yeah.
I remember now the name, his name was Mr. Sampath.
Oh
Uh,
yeah, Chandrakant Sampat. Yes.
Chandrakant Sampath.
Ah, is a maverick
Right,
investor, one of the
right.
best long-term investors in India.
Right. So kind
Right.
of period that you've seen and there was no availability of internet, no balance sheet. You didn't have the access to balance sheet. And
Yeah.
you're trying to understand the promoters and looking at in fixed income, once the money is gone forever. So you have to be double conscious than the equity guys.
I'll not tell you what is one of the name of the investor. Therefore, is not no more that, so I'll not speak out name. But I went to meet him. He was in Bridge Candy. He got a heart attack, and I went to meet him. I was a young boy, and he was like something 74 or something. And
Ji.
I just met him. I said, "Sir, how are you? How is your health?" He said, "Nifty क्या बाजार क्या लग रहा है?" Sir, आप cardiac लेके बैठे और so that kind of passion people used to have at that very very different. Some of the investors have done extremely well in that time.
Right. So I want to read your mind now. So basically, there are a lot of investors who have requested, and they're there on the call. They're present now, all of them, and they have requested me to ask this question. So we talked about Indian markets, but what the concerns that you see going ahead? We of course talked about India becoming $7 trillion, etc., etc. But where do you see what can go wrong in next 10 years' time, Vikram? What comes to your mind?
So I think any country which goes through a sweet spot cycle has a few fundamental pillars of the sweet spot. So you look at go to past and look at the how Japanese market did well in their demographic climate which was suitable to them. Then Europe has gone through that. Then US has gone through that. Finally, China did that way. Now India's turn has come. So it's a cycle, right? So demography is a most pertinent and most important. That's the starting point. And then you need infrastructure development. You need a good governance. You need a good education. You need a good entrepreneur skill. You need a lower per capita, which will start going up. So India, luckily, if you see today, it's falling in all the sweet spot. We have good governance. We have a infrastructure is improving at a very rapid pace. The entrepreneurship mindset. You can say English speaking people. So I think we are perfectly. We have nice. You can say a recipe ready for this. Now, this is a recipe. Now, what can fall? Let's add. So second is we are in a global jungle. We are not aloof, right? So we, if the oil price goes up, we get a shiver here. Or if the ITs US slowdown, the IT companies will start having shiver, and which can impact the overall economic growth. So there are various factors which can happen. I think geopolitical risk is going to continue to be there. As good as what it was earlier. If I remember 10 years or 15 years back, the world was more cordial. Now this is not as good as what it was earlier. If I remember 10 years or 15 years back, the world was more cordial world. There's a free transfer of innovation, free transfer of
Right.
idea, tourism. Now this has gone down. Today, you ask Indian how many Chinese visas are issued, not many. If you ask Chinese that how many Indian visas they are issuing, not many. So world has post-COVID, the globe suddenly look like a nuclear family. It previously was a joint family. So then you don't talk to this guy, you don't talk to the other cousins and all that. So that's how some of the trade barriers are started creating, which is very bad for the world as a whole, because being a global economy, you can intertransfer everything: knowledge, money, trade, even the tourism. So I think that is one area which is a worry. So world is not equal. World is a very, I can say, a very diverted world. People don't want to deal with a few countries. There are bans, there are people, trade restriction, import duty to particular countries. So this is a one area of worry. Second, India is still not able to find a solution for the 140 crore people who are going to drive the cars or two-wheelers or trucks or all that. So we are still struggling with the alternate energy, which is slowly coming up, electric vehicle and solar and alternate side of it. But we still don't have the final answer to this. So today also we are dependent 80% plus import for our fuel consumption. So that is one other worry, where whenever the crude prices shoot up, you start recounting your fiscal and trade deficit numbers and current account. So that's a one area which India need to work very fast. So that's a worry number two. Worry number three, I think so I always say that world going to recession is bad for every country, including India. If world is falling into recession, no one can do very well. If world is slowing down, good for India, because slowing down world can save your commodity costs. Your commodities will remain subdued, your oil will remain subdued. So right now we are in a perfect situation where the world is slowing down. If world goes into recession, where you say minus growth of the world, I can't believe that India can grow at 7-8%. India will grow at 4-5% or 3%. So I think we are lucky that we are in slowdown world. Third, if world is booming, which is not good for India, because we end up having hyperinflation in the emerging market, because all this high cost commodity transmit into the local inflation. So that's the summary. So today, I think the keeping a check on the global geopolitical situation is one thing to worry about. US growth is very important for the world, whether we accept or not. That's the dada of the world. And third is very importantly that how do you manage the your fuel? How do you create a local innovation? How do you bring the local things where you don't need to dependent on the world, like we did very well in mobile phones, or so many areas we are now localized. We are becoming more and more localized. We need to work more towards maybe semiconductors or the alternate fuel, where you have to quickly do it. We don't have much time. We have seen it happening in 2007-8 when oil went to 135. Last year it went to 120. Again, we are happy because it's 70. But assume that cycle start going because of seasonality or cut by the OPEC countries. I think again you will have a sign of worry. So these are the 2-3 signs of worry. And of course, the election. Of course, a good good governance, which is run by the current government.
Yeah.
If that changes, then we might grow slowly. I don't see India can be denied for the growth, whichever political party comes. But I think if it's a good political party who understand what is the growth and how it benefits the country and the citizen at large, then we can grow at a much faster pace. So I think these are the three things to watch out.
Sure. So now I want to come back to the fund. So basically, just want to understand, how do you select these stocks? A, whatever stocks that you select in your portfolio, and B, so how big is your team? Can you also talk to us about your team and the analysts that they're working for you, and how do you sort of come to a decision that this is our investment philosophy, or we don't
Sure,
have investment philosophy? I mean,
sure,
whatever, like we are flexible or whatever.
sure.
Yeah.
So we choose our fund structure, in the sense what kind of fund we want to offer to the market. And there are various type of funds. So you have a large cap where we don't take, it's a very high quality Nifty 50 company. We have multi cap where you go and touch BSE 500. We also have the conservative bond equity combination fund, dynamic asset allocation fund. So we created a overall structure of the funds. So depend upon what client with what risk he comes. Assume he doesn't understand much on asset allocation, then we have a tailor-made products for each and every client. That suppose the client says, no, I'm 65, I don't take a risk. I'll tell him to go to large cap or a conservative fund. If someone says I'm 27, I won't take a risk, let him go to multi-cap or we also run a 10 stock strategy, a focus 10 fund. So we send there. So I think we created first a nice basket where client has much ease to decide what risk zone he's falling into, what kind of appetite of risk he has. So we go to that. That's a point one. Coming to the second point, I'll stay with the team and then I'll come to investment process. We are, as I told you, we are 22-member team. We're adding 3 or 4 more people in next, I can say a month maximum. So 25, 26, maybe we'll be 30 next one year. So that's the number of people. Investment side, we have 5 full-time analysts and we have one very senior mentor who has just joined us. So the I can say 5.5 member of research team. Myself, there are 2 traders. So this is how we built a almost 9-member, 8.5, 9-member team, where every analyst has a sector allocation. Of this analyst, there are 2 who are also quasi fund managers who actually kind of help me to manage a fund, and they now take an independent decision. So we are upgrading the analysts who have stayed long period of time with us as well as in the market, and we are upgrading them to fund manage. So 5.5 analysts, you can say full time, myself. So this is quite large pool of experience which we have. Almost I can say we have total over 100 years of experience in equity research as a team, and there are 2 traders. So this is a team size. Coming back to the investment process. So I believe the
Yeah.
most important part, which I tell everyone, that I only look at 3 things: what to buy, when to buy, why to buy. These are the 3 questions you should ask yourself, and then you get an answer. So when to buy is a market timing, which is one part separate. I'll talk that separately. And then what to buy. Now, how do you arrive at what to buy and why to buy? Why to buy is very simple in India. In my view, India mein sector selection is not difficult. You ask a fresher MBA,
Sorry,
he
sector
will.
selection you said? Sorry, sector selection.
It's not difficult because you
Uh,
just Google it and you say which are the top 20 sector to buy in India, and that will give you a very right answer.
well said. Yeah.
So if you tell me that is consumer durable is a good opportunity, the answer is yes. Is capex cycle is a good opportunity? Answer is yes. If you say me is buying a good mutual fund company as a stock is a good, of course, yes, good opportunity. So it's very easy because India is a $2,500 per capita country. So everything is underpenetrated. To give you a couple of more anecdotes, only 1% people in India, the population of India, is 50% of India's air traffic. So it means 99% yet to come into that
Right,
game.
right.
So everything is underpenetrated. Simple because we are 140 crore people. Our average per capita is $2,500. So very frankly, it's a very easy to find a sector. So you don't have to spend much time on the sector, to be very frank. You have to spend a lot of time on a financial analysis, and most importantly, what to buy. What to buy is the most important. That now consumer durable is a great sector. Now, which company you want to buy with that, and why you want to buy that? Is he a market leader? Is he going to be a market leader? Is a better customer service? Is a better quality of management? The people are fully focused on the business. Do they reward their shareholder well? They don't trade every day in the market. So all these factors, so which is called management quality. So you want to see that what company you want to buy, what is the opportunity we have in front of it? Is the people a professional? Is the people even run by family, but they're professional, they understand the things, auditor quality, independent board quality, a lot of things we actually kind of combine in a basket and we say, okay, let's take the management on different areas. What are the contingent liabilities? Do they source their, suppose a company who is in washing machine and source the raw material from the group company, which is unlisted, and they transfer all the price there, a margin there. We don't want to buy this company. So there are various variable factors which we work, almost 18, 19 factors where we work, and we come to the final quality of management, where we spend most of our time. So 70, 65, 70% of time actually goes into the choosing which stock to buy and why this management we should rely on. If management is trustworthy, management has done a good job in corporate governance and overall keeping shareholders happy, I think that's a delight for investors like us. So we avoid getting into a small, very very unknown management where the past history has been bad. There are instances of complaints to SEBI and MC and all that. So we look at this very carefully. So being a credit guy or bond market guy, my time goes into the selecting किस पे कौन से घोड़े पे bet लगा रहे हैं, and that bet has to be right on the quality of management. Rest is history because under penetration है, opportunity बहुत बड़ी है. 99% of the country's people don't know what is happening in the country. 3% लोग equity में invest करते हैं, mutual fund में invest करते हैं. So you look at the opportunity. So opportunity wise, we are sold. There is a 20-year opportunity. But now what to buy?
follow-up question very quickly, if you allow me,
Yeah.
this quality. Vikram, don't you think this quality is overrated in the sense that, what if some of the stocks which have done well, but they don't do well? So, like in recent past, we saw all quality stocks not doing well.
So quality means, if you tell me quality is a MNC, the answer is no. If the quality is a pharma sector, the answer is no. Quality consumer, no. It's a quality of management. Now, whichever sector you are, right? It can be a small cap. We have a small cap in our portfolio, which is a very high quality. It's the quality of person who is running the company and what is his thought process. Is he want to give dividend back? Is he generating free cash flow? There are thousands of variables plays around quality. So the old mindset which you write, I mean, quality means what? Say quality is a Hindustan Lever, Nestle. No, I'm not about that. I'm talking about the quality of any company. You have to run through the screener, right? And then you find, is it working towards your requirement? So today we have 430 companies in our universe, not in portfolio, universe. So it means I can able to find out from India's overall basket 430 companies which I can invest into. So that's a large number, right? That's a pretty large number. And many of the stocks of them
Yeah.
are tripled in 1 year or doubled in 1 year. So I think it's quality of management, not the perceived quality of Unilever है तो ले लो safe है, Glaxo है तो ले लो safe है, वो नहीं.
Yeah, so that is very important. And don't you think how much to buy is also then the question? Because once the quality is identified, how do you take the bet on that, Vikram?
That's a good point. I will add up now in my speech. So what to buy के अंदर मैंने डाला था कि what allocation you want to do based on the. So that's why that I told you initially that we have created a fund structure where assume the benchmark is 5%. I can be overweight by 3% or 4%. I can't be versus benchmark. I can't be 20%. So again, you have to create vision because ultimately you are comparing yourself with some indices. And client is expecting you to do better than indices because he's given money to beat you, say Nifty 50. He's saying, Vikram, go and beat Nifty 50. I want that. I don't want anything else from you. Don't give me that Nifty is 20% going up every year. You don't give 1 year 80%, next year minus 30%. I don't want that. Just give me instead of 20, give me 24, 23, 22, 25, whatever you can do after expenses. So I think that's what our job is.
Yeah. So according to you, Vikram, how much, I mean, this is a question which keep coming from our investors. And I tell them, look, when you are constructing the portfolio, you should have at least 2 years of horizon to see to it that the fund manager starts outperforming the benchmark. Because when you construct the portfolio, you can't put a gun on the fund manager's head saying that मैंने तेरे को फीस दिया अभी 2.5% का अभी मेरे को 2.5% का मेरे को अल्फा चाहिए. So according to your experience, you spend good time. How much time you think you and your team is required or needed to outperform the benchmark?
So I'm a touchwood. We are outperforming all the benchmarks which were created. Even a 3-month-old fund, 5-month-old fund also is outperform benchmark. So we've done well. That's because of maybe stock selection and all. But you're right. I think I go with your theory perfectly that you need to give 18 to 24 months to a fund manager. First, you understand his psychology, his thesis, his processes, his team. If you allocate bet on that fund manager, give him 18 to 24 months time to give you the show you the right result, and that can accelerate over a period of time if he's following the consistently what he has committed to. That's
Right.
the most important caveat here.
Yeah, right.
Because in bull market we normally break our discipline. We normally try to chase. We move our quality basket to the lower quality because higher quality is moved faster, and then we say, "चलो यार एक काम करो इसको ले लेते हैं." फिर बेच देंगे. So that's where you do error. So if someone is following consistent philosophy of what he is guiding to his clients, I'm very sure that he can beat benchmark year over year for many.
Right.
And there are examples in India and world both that fund managers have done extremely well. They remain grounded, they remain disciplined, they remain around their strategy.
Right. So I have last two questions, and I would request our participants if they have any question, they can shoot their questions in Q&A box. So two questions, Vikram, and this is these are the questions that I keep getting from our investors when I interact with. One is there's always a debate between large cap, mid cap, and small cap, and there's a perception that small caps deliver higher returns than mid and small cap over a period of 10 years, 20 years time. What's your views and sense on that?
So clearly, I think no question about it. Small caps are the wonder pets, and the small turns mid and mid turns large cap. That's what has happened. Hero Honda was someday small cap, or Pidilite was someday small cap. Surely. So my point is that it's a correct way to do it, but only challenge, as I told you, where the whole process plays a big role, that which small cap to buy. I think if you are able to understand that what to buy and which small cap to buy, then you can win this theory. And I've seen people are making wonders in small cap. So I am also of the same opinion that small cap is always gives you higher return, mid cap is higher than that, and then you have large cap. So today, despite of that, we don't have a small cap fund. The reason is we are 3 year old. So we want to try slowly that first we launched large cap, put our hand to that, and we went to multi cap, went to the focus 10 fund. So slowly you build your expertise, slowly you gain your confidence of your clients, institutionalize it. So if you don't have that institutionalized format of building up the small cap portfolio, then you go wrong because small cap, the chances of doing errors are also very high. And the management grid, and unfortunately, every country in the world has gone through the small cap cycle where some management promise you something they're not able to deliver, or maybe because of the economic reason or whatever. But I think the biggest risk and biggest opportunity lies in small cap. That's what I can say. Large cap is very easy to do it because you have to keep on beating benchmark. They are great companies. Consistently, you have to only allocate the right concentration to that particular stock. So but the real charm and real challenge, or real, I can say that winning kind of opportunities, small cap, no question about it. But I'll put it to the client or investor that what is his risk appetite? If it's a 27-year-old, I'll tell him not to go to large cap and come to small cap. But if it's a 65-year-old, I'll say about no, don't even think about small cap because एक stock आधा हो गया तो आप डर जाओगे. So it's better you stay in the large cap where you are tested.
Right. So, dear participants, please write your question in Q&A box, not in the chat box. While you're typing your questions, I will see. We'll wait for 2 minutes. So, my last question, Vikram, is so what are you playing? How are your portfolios positioned at this point of time? Where do you see, maximum output can be generated? What are you betting on?
So as I told you, Vikas, that broadly all sectors in India are looking extremely good, all the sectors. But if you have to pick me a 5, 6 where we are betting on, we believe like say, just give an example of 1% of Indian traffic, 1% of Indian population is 48, 49% of India's airline traffic. I'm just giving an example. 3% of Indians invest into SIPs, right? What do you say? So I think so many people, 7.5% of population is total car population of India. So 7.5 is easily go to 30, 40%. So I'm just saying there's an opportunity across galore. It's not only one spectrum opportunity there. But if you ask me my favorite, if I have to, and which I'm betting on right now, we believe the one biggest theme is the retail coming to financial market. I think that we are still at 7% or 8% of financial saving coming to equity market, which is half of the total saving. So if India saves roughly $700-800 billion a year, only 3.5% comes to the financial equity market through mutual fund, insurance, and direct equity, whatever. This number, if you look at from any global parlance, are 7%, Vietnam is 40, Mexico is 40, Brazil is 40 plus, China is 45. Forget about the developed market, I'm talking about the emerging market. So India has to go from 7 to 30, say. So it means a 4 or 5 time opportunity. This is not verified. It will be 12, 15 years we'll do this number. So what to buy? Now, if retail comes to financial market, what are stocks to buy? Let me give you example. Either you can buy a brokerage company, you can buy a depository company, you can buy exchanges, you can buy a mutual fund company or insurance company. So you have to pick up one of these sectors and say, okay, this is what looks like great. I'm an entry barrier fan. I like to buy stocks which are entry barrier stocks. So I pick up that way. That's a one theme, for example. Second, I think very clearly the India is seeing a big change in the manufacturing cycle. The thanks to deglobalization, thanks to Modi ji's wave on the Make in India. I think now people are realizing that we need to be self-sufficient. It's a huge 140 crore to feed in. So you have to have a localized setup, whether it's a pharmaceuticals or mobile phones or anything else. And we've seen big change in the way mobile phones has been produced in India in last 10 to 12 years. Look at the Apple iPhone is made in India now, or Vande Bharat train, which will be exported from 2025, 26 to the South American countries and the African countries. So I think we are achieving that, initial point of move. So I think manufacturing capex as an opportunity is the next decadal opportunity in India. I believe that next 10 years are for the capex and manufacturing, where you had IT services were doing well in last 2 decades. Before that, agri was very important. Of course, there was a big patch of industrialization in between. But overall, we've seen these are the big patches and a big secular trend. And now we are seeing the manufacturing capex is going to be a big trend. That's the other theme. Third, I think the look at mortgage to GDP ratio in India. I mean, still at we are 10% or 11%. I mean, that number can be easily 50%. Also, beautiful part about India right now is the real estate prices have not moved up. In last 7 years, it's doubled roughly, and that double is because of inflation. The cement has doubled, or ceramics has doubled, so everything is doubled. So it's more inflation. It's not that there's a big change in real estate prices. Also, look at from the point of view of, I remember when I bought my first house in 1998, I paid 18% to HDFC for buying housing, taking housing loan, 18%. Today, I get a loan at 8%, right? So that's a structural interest rate downturn has come, which is very positive for India. And look at US now. That time US guys used to pay 2% on their mortgage loan. Today they're paying 6.5%. So compared to US, you are getting only at 1.5% higher. So there's a big opportunity that house owners are going to use it. People, a lot of people say this is going to be Western trend where people not buy a house. I don't agree with that. Indians are very conservative. They are savers. They want to have one house and then they make you on rent and stay in rent. That's a different thing. But they'll at least own one house. I think that's a big opportunity. Credit is a big opportunity where so many corporates are growing up. Bank credit is going to be very, very extremely good opportunity, both even NBFC and bank. So there are so many sectors, consumer durables, fashion, apparel, airlines. It's a massive, massive opportunity. Automobiles. I think we are here to there for so many sectors, so many. You have to just pick up a right management. That's what your job is. Sectors are very easy to define. I can tell you my junior most analysts can talk better than me about the sectors. But pick up the stock is where you really make the difference compared to others.
Sure, sure. A couple of questions quickly. We have another 5 to 7 minutes. One question is that generally, when you look at these industry leaders, any sector that you pick up may have an expensive valuations, obviously, because they command premium. So how do you balance between the industry leaders and someone which is emerging, but at times that emerging story doesn't work out?
Yeah, yeah. So I that's a very good question to ask. And sometimes, so again, it's a strategy, right? So if I'm running a large cap portfolio, I'll buy industry leader, whatever expensive it may be, because if I'm seeing a secular growth, right, I'll continue to hold that because I don't want to see, unless there's a big competition. That's a one. Second, like the question, I can't talk to the company's name, but say a sector like paint, right, where we are seeing a lot of new people are coming up. Some coming with a very good execution quality. The new people, new companies are coming up. Now, we want to see that someone who's executed earlier in other commodity or other sector is building this business with the distribution franchise, with the experience, with the past execution. We'll bet on that, then betting on someone who is starting afresh. I'll give you an example. If an IT company guy tells me that I'm building a paint company, I'll never buy. But a building material company guy is telling me that I'm getting to paint, I will still believe that he has executed in last cycle. He has built a very good brand, so I will go and buy. I hope that message is clear. So we look at the past record. That's why again repeating that promoter's track record is the paramount thing for me. That what is he has done in past, what is the history says. And I'm a firm believer if you don't read history, you can't build your future. So you need to know history, that what is his past background, what he has done wrong, right in past. And that is actually a success of the getting the future execution right.
The second question is when to exit. Markets are at 19,300 levels. So I would like to answer this question, and then I would request Vikram to add this. See, until you need money, if you ask me, because unless you need money, there is no point doing it. And plus, you've hired a portfolio manager, qualified portfolio manager who are running your portfolio very, very professionally. So they will have obviously their own thought process in terms of where to book profits, which stock to change, and where do you see more value emerging. I think if you've hired a portfolio manager, you should have complete trust and allow them to do the way they want to do it. But if you need money, then this is the time to take out money. Don't look at the benchmark. Now, I would request Vikram and invite his thoughts on this.
So because I had not done astrology classes, so it's very difficult to give the exact timing when to exit. But as I told you, it's a 20-year opportunity. I think you rightly described that if you don't need money, equity is the best asset class to invest into it. And we've seen in past also, yeah, like 20 years of Nifty return still 15.5, 16%. I mean, if you remove the tax, also still is a 12% tax-free opportunity. Where do you get this opportunity? Yeah? Today, when you buy a bond, your net returns are 5%. So, and more longer you go, you're sure that you're going to win this race. So I always give one more anecdotal to the people that Sensex has completed 43 years. And there are 11,000 working trading days in that. Okay, 100% time, if you take on a 10-year bet, you made this kind of return. And 96% time, if you stayed invested for 5 years, you made a positive return. So you understand that the longer you go, the more money you make. People who are holding the, whichever shares for long period of time, 20, 25 years, they made the best hay return out of this. So if Nifty can give 15% return, and if a fund manager can deliver even 17, 18 consistently, amazing. That's a big return you're getting. Where do you get this kind of return? And you have a mortgage cost at 7.5%, right? So 8%. So
Yeah. I think I would agree to your thought process. See, I would say that the way I look at it is that you have to have asset allocation, as Vikram rightly mentioned in the beginning itself. Once you are sorted with your asset allocation, then the only time that you should think about exiting is when you need money. Otherwise, you allow this asset class to grow, and we have seen how compounding works.
that's
I
a
mean,
very good point you made. Asset
3 years,
location, if
you
you,
see
yeah,
from where we've grown to where. I mean, the market itself has grown more than 125 times,
yeah,
if you look at from
yeah,
1981.
yeah.
So clearly, if you were looking at 100x sort of returns, then you should be investing. And I don't know why. I mean, this is something that I keep talking. Last 1.5 years, when we've gone through a difficult time, Vikram, post COVID, everybody got disappointed to an extent that they lost faith on equities. Now in 3 months time, they're the same people are coming back and adding more money. I said ये पहले करना चाहिए ना आपको जब हम बोल रहे थे तो. So I don't know, this perception, or maybe the immediate effect of the market perhaps add different flavor to investors thought process. And I at times disagree with this, and I'm being a little vocal about it, but that's how the reality is. Maybe you can add
No,
more.
no, you're absolutely right. And it's not India, it's across the globe. So most money comes at the top of the market. So that's how it happened. But I can say Indian investors are smarter than others. So this SIP trend actually always, fancy me a lot. And I believe this SIP trend is going to go bigger, bigger and bigger. I think people have become smart. People understand how to top up. People understand that if the markets are bad, to do it. Of course, that pink page headlines, or you can say that, those who are left out, they come at the wrong time. But I've seen the
Right.
overall maturity of our market is improving to a larger extent in last few years. And post COVID, I think people learned this. People had a lot of time, so people learn this better way. Yeah, but I've seen your kind of what you said disappointment in that 1.5 year. A lot of people have gave up actually. So year back, if you really open the books of market, all the capital goods companies are available at one third of today's value, and now it's over 3 times. So people want to, now the capex cycle, people want to kind of really buy. But I think a year back was the opportunity. So when there's a green scenario, or I can say what to say fearful scenario, it's the best time to buy a stock, best time to invest as much as money you want to invest, and then sit tight. That's all about it. And like Vikas rightly said, remove when you need money for something else. But if you have asset location, then why you need money for something? Unless there's some emergency in family or something.
Right.
Otherwise, you don't need money.
Yeah. And anybody who's coming on equities, and even if you come with some goal in your mind, then the minimum time frame can be looked at is at least 7 years to my mind. I mean,
Absolutely.
I don't see that people say 3 years or a year or 3 years. Maybe we have seen many times. Like, for example, you look at last 18 months. I mean, ever since Ukraine war has begun, that itself is about 13, 14 months. We saw only markets going down. तो ये तो होता रहेगा आगे, और ऐसा एक बार नहीं 10 बार होगा. But what is more important is that you have to have that kind of patience. And so my submission to all our investors is that when we are committing money on equities, I think you have to have faith on fund management team, and give them sufficient time to deliver alpha in your portfolio. With that, we'd like to
I will,
conclude.
I will, I will only take 1 minute. There's one good question
Please.
which I thought I'll answer, if with your permission, Vikas. There's
Yeah.
one question came on. Tell us about one of your product which you want to talk. So I will tell you about a different product which we
Sure.
have, Vikas, as a
Yeah.
fund called Focus 10 Fund, where we only invest into 10 stocks. Possibly, I don't think so. Any PMS or AIF has a that fund kind of model. I'm not very sure, but mostly no. So only 10 stocks in a market. We buy 4 large cap, 3 mid cap, 3 small cap. And this is how we created a 10 stock portfolio. It's very popular, getting popular with the clients. And I believe that's a very good strategy, because I, as an investor over a period of time, and I'm an equity lover from my college days. I did my CA and I was in love with equity from day one. It's only the career took me to bond market or treasury first, and then I came to equity. I was always having a 12 or 15 stock portfolio. I never had a more than 12, 15 stocks in my portfolio also. So I think 10 stock I believe is a great fund. I put a lot of money of my own on also into that. But I think that's a good opportunity. We have a good combination of large cap, mid cap, and small cap. So mid cap, small cap can give you the big upside, and large cap keeps the stability of the portfolio.
So these are what high conviction ideas that you pick up, or
Absolutely. It's a high conviction and not so much churn. So churn is only when stock doubles or triples, or there's some negative issues in terms of sector or the company, particularly if it's a very serious, not a very quarter on quarter kind of issue, but very serious issue. So it's a no churn kind of product, and it's a most highest convinced ideas.
right?
That's what we do. So we
So
launch a product in.
what sort of EBITDA margins that you look at, or earnings at earnings growth of the portfolio at aggregated level?
So earnings growth se zyada we look at again I'm repeating the quality of management
Sure.
first. That's a top priority. That's where you'll be surprised that out of 6 mid cap and small cap, all the small cap mid cap, we are net cash companies, and all the large cap except one, all are leverage company. Can you believe it? It's the other way around. Normally, large caps are cash rich and mid caps are so
Right.
that conservatism. One, and second, I think we look at the companies which are three things we look at. One, what is the next 5-year theme, 10-year theme of India? Within that is fits on one. Second, we look at the quality of management, which is most paramount. And third, is it an entry barrier? Can someone replace this or can someone not replace?
Very,
So I
very
think,
moated businesses that you.
and so we had just started this fund a few months back, 6-7 months back, and we had doubled in the benchmark. So that's because the markets are good. But I always tell clients that, always expect a 20% higher than benchmark. Don't ask for more from a fund manager. If he gives more, then he'll take away more also. So, but this is a market which has helped us, and stock selection has helped us. So we've done better in that particular cycle.
So how do you allocate, like 10% each, or like you will decide the
No,
percentage?
that's a good question. So we have 50% large cap, which is 4 stocks. So 12 half or 12 roughly. Then 3 mid cap, 10% each, and 3 small caps, 6-7%.
Okay. So, but then this can change, right? Like you have the mandate and you can.
Roughly, I keep it. I done my work in earlier avatar. So in Birla Insurance, I used to run a fund called Super 20. So that time Kotak 30 used to be there, mutual fund. And we say, let's beat that and buy number of stocks. So we went 20. And now I want to break my own records. I said 20, let's go to 10. So now we move to 10 stock portfolio. But this is, if you ask me, the cap bias will remain here on 50, 30, 20. I'll not change that. I want to take a lower risk and generate alpha on that, rather than taking a higher risk and then have a huge volatility on the portfolio.
So what is the benchmark here? Like which benchmark?
Nifty 50 TRI. Unfortunately, there are only 2 benchmark in India. BSE 500 now post SEBI's new rule.
Right.
TRI and Nifty 50. Now I can't have a 10 stock is on a 500 benchmark.
Yeah.
So the only benchmark I can follow is this. Our original plan was to have a mixed benchmark, a combo benchmark, but then SEBI has changed the whole rule. Yeah. No, but we can't do it now. As per SEBI, you can only use 2 or 3 benchmark. One is a metropolitan stock exchange, which I don't understand. How can I track that? One is a BSE 500, which is 500 stocks versus 10 stock, which is very crazy.
Right.
And third is a TRI, Nifty TRI, Nifty 50.
So this the international license, Vikram, last 2 minutes maybe. So just want to understand. So this international license that you talked about. So if this is like NRIs will be investing from abroad and you'll be investing in the domestic market, but or the Indians can also apply and do this investment through LR.
No, it's a one way. You're right. The first one is right, that NRIs and global funds and global investors, global family office will put their money into India product. So we are only right now one-sided, which is we are doing India inflow money, but we have a plan to go into the other way around, because Lansdowne also has a lot of European and US product. So someday, because we are still kind of baby, small company, someday maybe a 2 year or 1.5 year later, we'll have the LRS kind of product where they have a US centric product and we can give you the subscription in India.
So this, when we say that these NRIs can invest here, so it is at the fund structure level, or it is more on the PMS platform sort of thing where individual.
It'll be a fund structure level. It'll be a fund structure level.
So they will have an access to their NAV monthly valuation.
Daily NAV product.
Actually,
we have all the we are just kind of daily NAV product.
Okay. And then exits can be given to them, like you don't believe.
No exit load, like I told you. That we have a daily entry exit and no exit load to any of the clients.
This is basically an open-ended.
Open. All the funds which will run is open-ended. That's a philosophy of organization.
Sure. And this is a multi-cap one, right?
It will be a large cap. For offshore will be a large cap.
Okay.
For the offshore will be a large cap to start with, and then we are launching a focus 15 kind of product later. Okay. Because the 10 we cannot manage as per the UCIT rule because of the sector and stock limitations. So we'll launch a focus 12 or 15, but we are still not yet decided what's the next one. But the first one is clearly large cap, 80% large cap, 20% liquid or mid cap.
Understood. Thank you so much, Vikram. With that, I'd like to conclude the session here. It was great speaking with you. Thank you so much for enlightening all our investors with so much
Thank you,
of
Vikas. Thank
data
you.
points.
Really good speaking to you and every one of you, every investors of yours, and really thankful for all the questions you guys have asked. And Vikas, very good. You took out. Actually, once I felt you were like a TV anchor, a very serious, very good TV anchor, because you took out all the questions perfectly. So all credit
Thank
to
you.
you to take the best out of the
Yeah.
conversation.
Thank you. We get a
Thank
lot of questions. It is my duty to ask you, sir. I'm
no,
not left out with any other option.
no, you put it very well. I think. Thank you so much for doing this.
Thank you. Thank you so much. So
Thank you.
thank you, dear investors. If you wish to know more about this fund or anything that you like to know, or you want to speak to Vikram, separately, do reach out to my team and we'll sort of book an appointment and then, get this organized for you. So you can visit our website and do it. Thank you. It's www.aipms.com. Thank you.